U.S. President Donald Trump smiles during a trade meeting with Liu He, China's vice premier. Photographer, Drago, Bloomberg Copyright 2019 Bloomberg Finance LP Copyright 2019 Bloomberg Finance LP One of the reasons the Dow 30 and S. The major concerns revolved around the length of the current expansion, recession forecasts, the shrinking spread between short and long-term interest rates, the Federal Reserve shrinking its balance sheet, potential escalation of Trump's tariffs on China and other countries, the automotive and housing industries decelerating and slowing economies around the world. While the stock markets have bounced back due to the U.S. economy still projected to grow this year, even though it is slowing, the Federal Reserve pausing its interest rate increases and the hope for the U.S. and China to strike a trade deal, the overhangs to the equity markets and economy remain. Economic expansion about to become the longest since World War II. The current economic expansion will hit a decade in June of this year, which would match the longest on record of April 1991 to March 2001. It would also be almost twice as long as the 58 months experienced for the past 11 cycles starting in 1945. While the economy could keep on growing, just the length of the current expansion means a recession or at least a slowdown of the economy should appear sooner rather than later. Length of GDP expansions. Congressional Budget Office, National Bureau of Economic Research. Recession forecasts in the Congressional Budget Office or CBO, January 2019 report. It stated, the Blue Chip Indicators, January 2019, reported a consensus survey result for the probability of a recession in 2019 at 25% and the probability of a recession in 2020 at 37%. A National Association of Business Economics (NABE) survey published in December 2018 found that 20% of participants anticipate that the next recession in the second half of this year and a 30% chance by the end of 2020. The Cleveland Fed also estimates the probability of the economy going into a recession. It uses the yield curve to predict whether the economy will be in a recession in the future. It currently estimates the expected chance of the economy being in a recession next January at 26.5%, crossing above the one-quarter mark and moving up from December's estimate of 24.0%, in November's estimate of 20.3%, and October's estimate of 16.6%. So while the yield curve is optimistic about the recovery continuing, it does show some risk of a recession in the future. Probability of a recession. Federal Reserve Board, FRB Cleveland, Hever Analytics yield curve showing caution. Investors look at the 10-year Treasury minus the 2-year Treasury to help visualize the flatness of the yield curve. As the chart from the St. Louis Federal Reserve shows, a recession typically, but not always, occurs when the result is negative. U.S. Treasury 10-year and 2-year yield delta. Federal Reserve Bank of St. Louis. The graph from the Cleveland Fed shows the 10-year Treasury minus the 3-month yield spread, the orange line, compared to a 1-year lag for year-over-year GDP growth, the blue line. What it shows is when the yield calculation goes negative, the economy, typically, but not always, enters a recession. While the result is currently slightly positive, it also indicates economic growth should slow from last year's 3% year-over-year rate. U.S. 10-year Treasury yield versus 3-month yield and lagged by 1 year compared to GDP growth. Bureau of Economic Analysis, Federal Reserve Board, Hever Analytics, Macroeconomic Advisors. You can't have your cake and eat it too. The economy has been helped by interest rates decreasing over the past 40 years. As the chart below for the 10-year Treasury shows, after peaking in 1981 at over 15%, it fell to under 2% in 2016. While it has pulled back from its recent high of just over 3%, the economy can't be helped by such a secular decline again unless rates increase so that they have the opportunity to decline. 10-year U.S. Treasury yield. Macrotrends.net. Keep in mind that a large percentage of people will say that increasing interest rates are positive since it indicates a stronger economy. While that to a large degree is correct, if declining interest rates were positive for the stock market, it can be easily argued that rising interest rates are negative for stocks. Over the long run, stocks trend up as companies generate more revenue and profits, but higher interest rates put pressure on the valuation multiple investors are willing to pay for equities as fixed income investments become more viable. The Federal Reserve is shrinking its balance sheet, besides lowering short-term interest rates dramatically when the Great Recession hit and keeping them below 0.25% for 7 years from late 2008 to early 2016. The Fed substantially increased its balance sheet, from under $1 trillion to $4.5 trillion. This helped the equity markets considerably as it pumped capital that needed to find a home. However, downsizing its balance sheet creates a headwind for stocks as the Fed shrinks it. In just over a year, it has fallen by a bit more than $500 billion. Federal Reserve Balance Sheet, Board of Governors of the U.S. Federal Reserve System. China negotiations seem to be making progress over the past few days. President Trump's trade negotiating team has been meeting with China's Vice Premier Liu He and his team. They seemed to have made progress on the easier issues, but still have a ways to go on the harder ones, such as forced technology transfers and stealing intellectual property or IP. Both sides want to make a deal, and both will declare whatever they come up with as a win for everyone. The key will be how much will Trump cave on the tough ones. If the two sides are not able to strike a deal, then Trump has said that tariffs will increase from 10% to 25%, which would cause major disruptions and impact both the U.S. and China's economies. The stock market seems to be pricing in that a deal will be struck, and the economy would definitely be negatively impacted if a deal is not reached. Housing hit by higher interest rates. Existing home sales were down for the third consecutive month in January per the National Association of Realtors. They decreased by 8.5% year-over-year and have declined year-over-year for 11 of the past 12 months. Pending home sales are also showing weakness as they fell 9.8% year-over-year in December. Existing home sales. Copyright 2017, January. Existing home sales, National Association of Realtors. All rights reserved. Reprinted with permission. February 24, 2019. The National Association of Home Builders data shows that single-family home starts are also down year-over-year. From November 2017 to November 2018, starts are down from 948,000 per year to 824,000, a drop of 13%. With the downturn in interest rates, this sector may recover to a degree, but it probably won't be a huge driver to the economy. Single-family home starts. SNOB, Wells Fargo Housing Market Index. U.S. Census Bureau. Automotive industry tapping the brakes. The U.S. auto industry is also experiencing a slowdown. Edmunds forecasts that 1,271,009 new cars and trucks will be sold in the U.S. in February for an estimated seasonally adjusted annual rate (SAAR) of 16.7 million. This reflects a 12.3% increase in sales from January 2019 and a 2.2% decrease from February 2018. Although the drop-off in sales is rather subtle year-over-year, February is shaping up to be a good barometer of the gradual sales decline we expect through 2019, said Jeremy Acevedo, Edmunds manager of industry analysis. We're really starting to see a slump in retail demand that stems from the growing costs of new car purchases. It's easy to point fingers at anomalous factors like the polar vortex as the reason for a sales slowdown, but the numbers don't show that's the case, said Acevedo. Record high interest rates and rising average transaction prices are what's really putting pressure on the market and keeping car shoppers at bay so far in 2019, said Acevedo. The chart below from the St. Louis Federal Reserve Fed system shows that auto sales have been essentially flat since early 2015. They also topped out around 16.5 to 17 million per year in the 1999 to 2006 timeframe. U.S. auto sales U.S. Bureau of Economic Analysis. International growth decelerating in January. The International Monetary Fund or IMF projected, while global growth in 2018 remained close to post-crisis highs, the global expansion is weakening and at a rate that is somewhat faster than expected. It now projects global growth at 3.5% in 2019 and 3.6% in 2020, 0.2 and 0.1 percentage points below last October's projections. The IMF's estimates show a slight recovery in 2020 due to emerging markets and developing countries rebounding, while advanced economies such as the U.S. continue to slow. IMF GDP projections. International Monetary Fund. The U.S. is projected to grow faster than other advanced economies in 2019 but could slow down in 2020 to match their lower growth rates. While China's growth rate is slowing, it is still substantially higher than the U.S. From the International Monetary Fund, here are various countries' estimated growth rates in 2019 and 2020. U.S. 2.5% in 2019 and 1.8% in 2020. Euro area 1.6% in 2019 and 1.7% in 2020. Germany 1.3% in 2019 and 1.6% in 2020. United Kingdom 1.5% in 2019 and 1.6% in 2020. Japan 1.1% in 2019 and 0.5% in 2020. Russia 1.6% in 2019 and 1.7% in 2020. China 6.2% in 2019 and 6.2% in 2020. India 7.5% in 2019 and 7.7% in 2020. The following articles provide information about 6 metrics that show President Trump did not inherit a mess from President Obama. Fact-checking Trump's 8 economic statements in the State of the Union. Why Trump and Republicans have gone radio silent on GDP growth. Why Trump will declare a win on a China trade deal but will kick the can down the road. How much Trump's tariffs are impacting consumers and corporations, and that his budget deficits are about to become the largest in history.